get started. So welcome everyone to LPC's second quarterly market update of the year. LPC is an independent tenant advisory firm with 6 offices across Australia and New Zealand, and we are dedicated to representing occupiers in all aspects of commercial real estate and achieving tenant-friendly outcomes. We've observed over the years that most of the market commentary tends to reflect the landlord's point of view. In contrast, today's session is designed specifically for tenants. Our team of experts will provide a high-level overview of the Q1 2026 conditions across the office, retail, and industrial sectors throughout ANZ. And as always, this will be done through the lens of the tenant. So I'll be your moderator today, and I'll also provide the stats for each sector. Chris will be providing an overview of workplace trends, specifically work from home for the office market. Julian will discuss the office markets more broadly and some strategies to achieve better outcomes. Adrian will be discussing all things retail, and then Graham will be discussing the industrial market. So the agenda today will have the office, snapshot, retail, and then industrial. If we have time at the end, we'll have the Q&As. However, please feel free to write questions throughout. There's a Q&A function in the chat, and we'll answer those questions as we go along. So just to get started, I'll share a few key insights from some news articles published over the last quarter and across Australia and New Zealand office, retail, and industrial sectors, highlighting some of the trends we're actively helping tenants navigate. So in Melbourne, Dexus has put on hold plans to develop a new office tower that they secured approval for in 2019, showing the effects of rates and increasing construction costs have on getting new developments out of the ground. Work from home continues to be a hot topic within the office market globally. Locally, there was a recent decision by the Fair Work Commission that found an employee's direction to return to work at the office was lawful, despite contracts granting their employees rights to work from home. This decision is now subject to an appeal. And in Victoria, the Premier has fallen out with her Business Advisory Council over her government's plans around legislating the right to work from home. Chris will discuss work from home and its impacts more directly shortly. In retail sector, the low vacancy rate in large format retail has made it attractive for investors, not so much for tenants as they navigate increasing rents and high costs. The Iran war and property prices is affecting major retailers, with Wesfarmers saying prices will have to go up across the board. Adrian will explain the impact in the retail section. On the industrial front, the sector continues to be invested in heavily. AI and data centers emerging as the new class of industrial asset. Graham will inform us what it means to the already tight industrial market. Starting off with office, a quick look at the stats. Australia's national office vacancy rate has edged up over the past 6 months, rising from 15.2 to about 15.9 as of Jan 26, largely driven by the completion of new developments across the major office markets. Non-CBD locations experienced a more pronounced increase, with vacancy moving from 17.3 to 18.5. Perth and Canberra were the only CBD markets to record a decline in vacancy. Melbourne continues to have the highest vacancy rate nationally, increasing from 17.8 to 19, reflecting the lingering impacts of its extended pandemic lockdowns. Sydney also saw a slight increase to 13.8, although there are clear signs of strengthening demand. Looking ahead, Brisbane is expected to see slowdown in new supply over the next 3 years, and when combined with ongoing tenant demand, vacancy is anticipated to trend downward. In New Zealand, vacancy rates have also increased across the 3 major cities. On to Chris.
Good morning. So, office attendance rates in Sydney, Brisbane and Melbourne have been diverging for some time, and the gap is growing. In fact, the stats here are from early 26 for Melbourne and 25 for Sydney and Brisbane. So you could expect those rates for Sydney and Brisbane to have improved since then. The gap is driven by several factors, including structural, behavioural, economic and policy differences across the 3 cities. Next slide, please. So firstly, behaviour is probably the biggest explanation for Melbourne's Melbourne's habits in relation to office attendance, and there's actually been a structural change to a permanent state of hybrid working in all markets. But in Melbourne, they had longer and stricter lockdowns, and that reshaped their work habits significantly. This has led to a higher sustained adoption of hybrid and working from home and a resistance to return to the office mandates. Whereas in Sydney, it rebounded quickly to pre-COVID levels and now has exceeded that, and office norms and culture have returning to pre-COVID state, whereas Brisbane has outperformed both on this target. In terms of leadership, there's a very different policy from the government and corporate institutions in Sydney, which have encouraged a return to work, whereas in Melbourne, it has actually been very passive, and the government is actually trying to legislate working from home, which has been quite controversial. In Brisbane, they acted early. After not having many lockdowns, they decided that they would reduce transport fares to 50 cents across the board in 2024, and that has had a measurable impact on the amount of activity in the CBD. As far as transport economics are concerned, there's a very strong feedback loop between the quality of public transport and the cost and attendance at the office. In Brisbane, that's already been proven by the reduced fares, and across Australia, wherever commute times are longer, there has been a reduction or an impact on return to office rates. Sydney, for example, has a very effective transport network, and CBT and accessibility to the CBD has been driving attendance rates much higher. In Melbourne, the specific issues they have is a lot of major infrastructure works and disruptions that are affecting transport access, and a strong habit post-COVID for people to try and reduce the cost and time of commuting. Since then, Melbourne has now made transport free, which is partly a response to poor attendance, office attendance, but more immediately a response to the fuel crisis, which is certainly affecting commuting habits as well. As far as the workforce is concerned, there's a very uneven dynamics between the different cities. Sydney's seen very strong employment growth, particularly in the CBD, and recovery to higher than pre-COVID levels, whereas Melbourne is still lagging. It's below its pre-pandemic workforce peak, and there's also quite a bit of dispersed activity where people are working outside the CBD, remotely, or in sort of decentralized locations. Brisbane recovered much more quickly than both cities because they had very few lockdowns during the pandemic, and they have encouraged public transport to a much greater degree. AI has another impact that is emerging, and its impact on employment growth can't be predicted, but it will certainly have an impact in the next year or 2 years. As far as hybrid work is concerned, demand is actually very uneven, and that's now a structural change. There are very high densities on peak days and very low densities on off-peak days, which is more extreme in Melbourne. And there needs to be some rethinking about the way in which retail and other providers cater for those peaks and troughs. In the case of Melbourne, low land costs and lower utilization is driving an excess of supply, as we've just seen from Dexus cancelling one of its major projects. Performance of the property market also has an impact on the three cities. It's not performing well in Melbourne. In both cases, there's been a flight to quality buildings, which are more attractive to staff and helping to increase attendance rates. But this is leaving a very poor sort of subprime market and higher vacancies. Can we move on to the next 2 slides, please? So if we look at Sydney at a snapshot, the state has actually been driving people back to work. The vacancy rate is 13%. It would previously reached a peak of 87% post-COVID, and that is continuing to grow. Public transport has surged in terms of the number of journeys, particularly on peak days, and work from home has not been mandated by the government. So this creates a virtuous cycle where a good transport network is actually driving higher attendance. In the case of Melbourne, next please, much higher vacancy. and much lower attendance rates with a peak of 71%, and that's the most recent data. There are generally longer commutes in Melbourne, which are not supported by a good transport system. And the government has actually tried to legislate, or has legislated, that people should be allowed to work from home a minimum number of days. So this is creating a vicious cycle. One of the factors being transport, which is driving a lower attendance rate. So I suppose in summary, the implications of this for your property portfolio are that divergence in office attendance is actually being driven less by economics and more by behavioural and institutional settings. So it's really policy and access to transport, which is the main factor that will help to overcome these behaviours. But it's certainly indicating a much structurally lower utilisation of office space in Melbourne and the consequent effect on that market. So you really need to have a different strategy for different markets depending on these factors. Thank you.
Thanks, Chris. The LPC barometer shown on this slide will be used across all sectors in today's market update. Each presenter will indicate where current market conditions and lease norms sit along the barometer, providing context for recommended tenant strategies. Focusing on the office sector, in terms of lease norms, it's still very much unfriendly. Occupiers have an opportunity to continue pushing more tenant-centric provisions, particularly in areas such as risk allocation, obligations, and guarantees. Progress in these areas, whilst often less visible, is meaningful and will help shift the barometer towards equilibrium. In terms of market conditions, with the exception of a limited number of assets, the office market remains tenant favourable. This is driven by elevated vacancy levels and relatively subdued tenant demand. Landlords are increasingly conscious of the risks associated with prolonged vacancies and are therefore motivated to transact. This is evidenced by initiatives such as speculative fit-outs with additional rental abatements, even on shorter lease terms of around 3 years. If we move to the next slide, in this table we outline our recommended strategies for tenants along with the associated outcomes. This framework will be applied across the different sectors with relevant strategies highlighted for consideration within your own portfolios. For office tenants, the primary strategy we recommend is to prioritise a lease restructure ahead of expiry. Given the current leasing conditions, pursuing an early lease restructure can support broader business objectives whilst enhancing portfolio efficiencies. Additionally, in an environment of elevated interest rates, landlords are increasingly focused on improving asset yields. One of the key drivers of yields is the weighted average lease expiry of a building known as a WALE. Longer WALEs generally reduce perceived risk and can positively influence asset valuations and sales. As a result, tenants may be well positioned to leverage a landlord's desire for income security by negotiating favourable lease terms in exchange for extending lease commitments ahead of an expiry date. Thank you.
Thanks, Julian. We'll now move on to the retail market snapshot. We'll have a look at the leasing trends, then we'll look at the large format shopping centre CBD overview, and then the tenant perspective. So looking at the trends, Australia's retail market remains mixed, with conditions varying across the different segments. As mentioned in the articles, the large format retail and major shopping centres are tightening, with vacancy declining due to limited new supply and consistent tenant demand. This is reducing options for tenants seeking space in these formats. Across other retail segments, conditions are more stable, although outcomes differ by location, with some submarkets experiencing elevated vacancy and therefore offering more leasing flexibility. On the rental side, occupancy costs are coming under increasing pressure. In many markets, the face rents are rising while incentives are tightening, particularly for well-located, high-quality space where demand remains strong. In addition, the CPI is trending upward, which will flow through to annual rent reviews and further increase occupancy costs for tenants moving forward. Over to Adrian.
Thanks, Ed. So, unlike the office market, lease norms in the retail sector remain largely tenant unfavourable. Landlords hold a structural advantage. They operate across large portfolios, have deep market knowledge, and negotiate leases day in, day out. Individual retailers rarely have access to the same intelligence, and that imbalance consistently shows in lease outcomes. Market conditions vary considerably across the retail categories, and in the current environment, with cost of living pressures weighing heavily on consumer spending, there is a reasonable argument that conditions should be shifting in the tenant's favour. However, many landlords continue to price and negotiate as those external pressures do not exist. The challenges retail face beyond their four walls are largely being absorbed by the tenant, not shared by the landlord. With the retail sector under increasing strain from rising input costs, softer discretionary spending, and the compounding effects of global uncertainty, a more collaborative approach from landlords would go a long way. Sustainable tenancies benefit both parties, and landlords who recognise that reality are better positioned to retain quality occupiers and protect long-term asset performance than those focused solely on near-term rental outcomes. If we move on to large format retail, so the Middle East conflict has directly affected the large format retail sector. Gone are the positive tailwinds we saw from 2025 on the back of interest rate cuts and wage growth. Retailers who carry heavy volumes of imported goods are now affected by diesel fuel increases as well as delay in global logistics. Even on the domestic front, retailers are feeling the pinch from the increased fuel and diesel costs on road transport costs. All these have resulted in a reduction of discretionary spending, with a recent report from the Westpac Melbourne Institute Consumer Sentiment Index showing that the time to buy a major household item had reduced by 15% in March alone. Retailers are responding by assessing their portfolios and looking at ways they can optimise their performance. Over the past months, we've already seen Barbecues Galore announce they are closing 5 stores, whilst Pet O are looking to vacate 11 sites across the eastern seaboard. There continues to be a shortage of available properties in the large format sector. However, this may start to reverse if more retailers look to vacate good quality assets. Net rents are holding for the time being, with rates below $300 a square metre becoming increasingly rare. While most landlords are open to offering incentives on new sites, there is a reduction in capital contribution for fit-out works, particularly among private or small landlords. Renewal incentives are almost non-existent due to rising borrowing costs, and expertise is required to extract as much value from the negotiation as possible. Moving on to shopping centres, retail tenants in shopping centres are currently being squeezed from both sides, rising occupancy costs at lease renewal and softening consumer demand. Performance in shopping centres are very category dependent. Food services and tenants offering an experience are outperforming, while like large format retail, discretionary retail is under pressure. ABS data showed growth led by cafes, restaurants and takeaway food services, up by 8.7%, followed by clothing and other retailing, while household goods and large retailers saw moderate gains reflecting ongoing household budget pressure. In addition, the Roy Morgan Index shows consumer confidence dropped to 68.5 in March 2026, with only 15% of Australians saying they are financially better off than a year ago. Around 86% of consumers now prioritise price when making purchasing decisions, and around 75% identify as bargain hunters. This is shaping how tenants trade, consider their stock, and the positioning of items within the store. Most major shopping centres are experiencing low vacancy currently, and tenants on 5-year leases expiring in 2026 could face higher rent increases, as many of these leases were signed during the pandemic when rents were much lower. On top of this, landlords are continuing to seek unreasonable annual increases. Just this past week, I've encountered a major shopping centre landlord being unwilling to move from a CPI plus 2.5% model, which currently equates to a 7.1% increase using the current CPI figures. That's almost the equivalent of having a market review just on an annual basis. If we look at CBD, national CBD foot traffic has rebounded to 94% of pre-pandemic levels, with retail turnover now 21% above pre-pandemic levels. Brisbane, Perth and Adelaide have already exceeded their 2019 benchmarks, while Sydney and Melbourne are increasing, supported by public transport upgrades and precinct revitalisation. Rents are growing at a very marginal rate and good sites are becoming harder to find. Demand is currently being driven by dining and hospitality on the back of strong weekend and evening visitations, as well as entertainment as consumers seek retail experiences. With suburban retail, consumer habits are continuing to shift, more so with the effect of fuel price increases, with daily convenience trips now replacing the traditional big shop model, turning neighbourhood strips and convenience centres into much popular destinations, given they're closer to daily commuting community infrastructure. Retail is offering something that can't be replicated online, whether it be food, services, or convenience, are the ones that are thriving. Negotiations for tenants, however, continue to be challenging, as many landlords are reluctant to negotiate on a position that meets the tenant's requirements and needs, even in the face of rising land tax costs and increasing insurance premiums for vacant shops. With new sites, retailers continue to be highly selective when evaluating new sites. With rising fit-out costs and ongoing economic uncertainty, tenants are prioritising locations that meet all operational needs, particularly exposure, signage and parking. Secondary sites that may have been acceptable pre-COVID are no longer being considered. If we look at the tenant's perspective, there are a number of strategies that a tenant can enact to receive favourable outcomes. In orange, we have highlighted portfolio optimisation, review and reset that has relevance to the slides that I've just gone through. So reviewing performance within the portfolio consistently is important to ensure that long-term leases are future-proofed, so they'll not be a constraint to the business in future years. Thank you. I'll hand back to Ed.
Thanks, Adrian. Yeah, just moving on to the industrial market snapshot. We'll have the overview of the stats, the current status, the trends, and then the tenant perspective. So with industrial across both Australia and New Zealand, the industrial vacancy rates remain stable. They continue to sit at historical low levels, driven by constrained new supply and ongoing tenant demand absorbing all available space. This supply tightness is most pronounced in the key freight and logistics corridors, where demand for large-scale distribution and last-mile facilities remains quite strong. While some markets have seen slight increases in vacancy as new developments are completed, overall availability remains well below long-term averages. As a result, tenants continue to face upward pressure on rents and reduced incentives, particularly for modern, well-located industrial assets. Handing over to Graham now.
Thanks, Ed. Looking at the barometer again, very similar to retail, the lease norms are squarely in the tenant unfriendly component, given those supply and demand sort of parameters that Ed was alluding to. Limited supply, low vacancy is making it a challenging market for tenants. From the market conditions point of view, you'd say it's generally probably sitting in a balance. There's new supply coming on, but the demand still remains strong. So it's we're seeing stability across most of those key factors. The Australian industrial market has been structurally a landlord-favoured market for over an extended period of time, supported by long-term demand fundamentals and constrained supply. The conditions are beginning to normalise. Demand is moderating. New supply is entering the market. And these shifts have not materially altered the balance of power in most locations. Tenant leverage remains limited, particularly for well-located and high-quality assets. Achieving tenant advantage outcome in this environment requires discipline and strategy. It means aligning property decisions closely with business objectives, leveraging market intelligence, and in identifying areas for leverage through the experienced advisors. Above all, the success of an outcome will depend on timing, recognising market conditions, creating windows of opportunity, and taking action to do so. On the next page, we'll explore the practical strategies designed to assist the tenants in that regard. When you look at vacancy, national industrial vacancy now is slightly higher at approximately 3.2%, but remains low by historic standards, maintaining that landlord-favoured market. Prime precincts in Sydney, Melbourne and Perth still remain very tight, and early engagement really is critical for securing high-demand locations. ESG and sustainability considerations are now baseline requirements and not differentiators, especially for global occupiers. That is a market-by-market proposition. Interestingly, in markets like Perth, which is dominated by private owners and developers, not as institutionally focused, the developments are still going ahead without ESG, without Green Star ratings. tenant demand at that level is then having to focus really on the brand new developments and pre-commitments. We see a two-speed market across the board: modern, high-spec, well-located industrial facilities are limited compared with secondary stock. Landlord of the premium assets are commanding higher rents, while owners of the older or secondary stocks face limited rental growth and must offer greater incentives to tenants. Understanding this divergence is critical for tenants and investors alike when positioning themselves strategically in the market. And the other thing we're seeing is that highest and best use owners are actively reviewing industrial land and facilities to unlock value through redevelopment and rezoning. Strategic locations are being targeted for alternative industrial uses, logistics expansion, or mixed industrial commercial development. Tenants can benefit from indirectly through increased supply or redevelopment incentives, and investors are increasingly focused on long-term land optimization. When you look at the tenant perspective and the strategies that we're employing, the lease restructuring before expiry, identifying opportunities, albeit limited, within a market and being able to act on those in a timely fashion enables you to leverage market conditions and covenant to get the best outcome. I'm going a bit out of order here, but premises due diligence and negotiation is a critical component. Thorough due diligence and negotiation strategies allows the tenant to secure the terms that meet both immediate and medium-term operational needs, and that they can review that throughout the tenure of the lease. With changing ESG policies and increasing sustainability requirements, early diligence helps identify potential compliant risks, optimize energy and environmental performance, and negotiate favourable lease terms with support long-term business resilience. And finally, the plan to go early, and I think this can't be overstressed in the industrial market. When you've got supply-constrained markets, early research, developing strategies, and planning is essential. Optimal solutions may not be readily available, and it's an assumption that a number of our clients have made that there'll always be an option available in the market that suits, and in some markets that has proven not to be the case, or that there may only in fact be one or two options, which limits that ability to create leverage within a marketplace. So our advice at the moment is commence the process early. 12 months in advance of lease expiry is generally, in an industrial space, not enough, particularly if the best solution is going to be a design and construct outcome.
Perfect. Thanks, Graham. Can I have a quick Q&A? Please feel free to ask any questions. I know if anyone had anything else they wanted to add from our panelists over the course. Haven't got any questions as yet. I think it do have one in the chat. Hold on a second. All right, very informative. Thank you very much. Look, I think we can just wrap it up there. If you have any other questions, we've got everyone's details just here on this slide, so feel free to shoot us an email or give us a call, and we'll be able to answer any specific questions and help out. And then also, don't forget to please join us on our next market update, which will be on the 6th of August, and we'll look at the Q2 status, and we look forward to seeing you all then. Thank you very much. Get started. So welcome everyone to LPC's second quarterly market update of the year. LPC is an independent tenant advisory firm with 6 offices across Australia and New Zealand, and we are dedicated to representing occupiers in all aspects of commercial real estate and achieving tenant-friendly outcomes. We've observed over the years that most of the market commentary tends to reflect the landlord's point of view. In contrast, today's session is designed specifically for tenants. Our team of experts will provide a high-level overview of the Q1 2026 conditions across the office, retail, and industrial sectors throughout ANZ. And as always, this will be done through the lens of the tenant. So I'll be your moderator today, and I'll also provide the stats for each sector. Chris will be providing an overview of workplace trends, specifically work from home for the office market. Julian will discuss the office markets more broadly and some strategies to achieve better outcomes. Adrian will be discussing all things retail, and then Graham will be discussing the industrial market. So the agenda today will have the office, snapshot, retail, and then industrial. If we have time at the end, we'll have a Q&As. However, please feel free to write questions throughout. There's a Q&A function in the chat, and we'll answer those questions as we go along. So just to get started, I'll share a few key insights from some news articles.